Welcome to Investing for Generational Wealth. I'm John Lai. I'm joined typically by my partner, Keshav. Can't be here today, but we're here to help high earners just like yourselves invest outside of the stock market passively to achieve long-term generational wealth through superior risk-adjusted returns, long-term passive income and cash flow, and of course, tax benefits. Together with investors, we're renovating over 1,000 apartments and building over 500 single-family rental homes. Before we begin, a typical disclaimer: we're not financial advisors. All investments are subject to risks, along with the possible loss of money you invest. So perform your due diligence. Consult your CPA, your attorney, and whomever you typically consult. I'm your host again, John Lai, and welcome to today's episode, How Real Estate Can Help You Retire Confidently. Today's guest is Michael Parks. I'll give a little bit of background, but Michael, feel free to chime in with your bio. Michael, through his wealth fund, Navigator Wealth Fund, assists clients in diversifying their portfolios into high-quality real estate and private money loans. And he's done this for 10 years. He has a background in REITs, managing over $30 billion, spanning hotels and other assets like commercial offices, logistics, and senior living facilities. Michael, do you want to give a longer description of how you got to where you are today?
Sure. Yeah. Thanks for having me on, John. I appreciate it, and glad to talk with you and your audience here. I was a technology guy. That may sound familiar to many of your audience. Grew up at Accenture doing IT consulting work. Was there a long time. Really enjoyed it, and then when I left Accenture, I've always had a passion for real estate, and I was doing some real estate on my own. Dabbling in vacation rentals and that sort of thing, and I said, hey, how do I combine my professional expertise with my passion on real estate? And that's when I got involved with the REITs, Real Estate Investment Trust. And I ran most of the technology department there on 10 different ticker symbols on Wall Street, and really started to learn about the big business of real estate, how you do it professionally, not just for yourself on a smaller scale, and really liked it. So got educated, created some partnerships, and launched my company, and now the Navigator Wealth Fund with my partner, Jeremy Lemire. So the two of us are off and running, helping many people like you do find their path to retire confidently through all the three things you mentioned right at the outset: the cash flow, the tax benefits, and superior risk-adjusted returns.
Did you, and I didn't catch the firm that you worked for on Wall Street. Which firm was that?
So the company is the RMR Group, and the RMR Group was a manager of REITs, many different ticker symbols, different REITs, and then other operating companies. I was a technology leader there.
Got it. Okay, perfect. So did you ever go through the typical like residential real estate, then jump to commercial, or because of your experience with REITs, did you automatically like jump that bridge over to commercial right away?
Interestingly, no. It was more residential first, and even before I got to the REITs, I had started doing some of my own residential, rentals. But I think multifamily is still a very good place to be. In terms of the drivers of the multifamily marketplace, I believe are still in place for long-term growth at lower risk. So my partner, Jeremy Lemire, he took the other path. He certainly did some residential, but he did many of the self-storage units in greater Wisconsin. So most of the big self-storage units in greater Green Bay area he runs. And so we've got a combination of commercial and residential. Certainly with the REITs, I've learned a lot about commercial, but that's not where I started.
Understood. Okay. The subject of today, of course, is retiring confidently with real estate. how do you help so an investor is interested, and a lot of the people in our audience are potential investors or investors. And so they're typically, and this is where I came from as well, they're typically invested in, your IRAs, your 401ks, which is the broader equity and stock and bond markets. They're less knowledgeable about the real estate market, either commercial or residential. And the people who do find residential or commercial, they find it through other means. And it's probably like the average investor, it's probably, the 30% of their portfolio. How do you educate your audience, and how do you help them, to the end goal, which is retire confidently?
That's right. Yeah, I think it's important to meet people where they're at. And so for me, it's very much one-on-one. People see what I'm doing and the types and they're interested, right? And so I think what's great about this whole world of real estate and alternate investing is there's a lot of different ways to get involved. And whether it's different asset classes, like you just talked about with multifamily versus commercial and different types of commercial. Also, you got equity plays, you got pref equity, you got lending options. There's just a lot of ways to be involved. So how I get engaged is I meet people where they're at. So I try to first understand where are they in life, and are they in their late 20s and finally have some money to put together that they really want to go more heavily into investing. They have enough of a portfolio that they can do something with it. Or they may be Gen Xers and they're like, hey, I want to retire. I'm not sure how to get there. I might have enough money. I might not. Like, how do I retire confidently? And
Right.
like, I'll admit I'm in that bucket, right? So in terms of being the Gen Xer and finding that path to a confident retirement, that means making sure you've got a line of sight on cash flow, that you will not run out of money. And how do you create the right risk adjusted portfolio? So for me, it starts with a consultation with each person. Where are they at? What are their goals? And then we start talking about all the different opportunities, from lending to equity plays, different asset classes, and what's their risk tolerance. Whether
Yep.
that's investing with us or investing on their own, all of those things, I'm glad to have those conversations and just help people figure out their path to wealth, right? That's one of the things that we talk about is find your path to wealth. Yours may not be mine, may not be somebody else's, but I'm glad to help you find yours.
Um, as much as these webinars are not a promotion for anything, can you describe what your fund focuses on? And we talked a little bit offline before the webinar started, but could you talk a little bit about what that is and then how you help potential investors, and then maybe more broader than that, like how investors can get involved in real estate?
Yeah, for sure. So my fund, the Navigator Wealth Fund, it's navwf.com. Thank you for allowing me to give the plug. So we focus on multifamily properties and self-storage. And also we will be launching a build to rent, like duplexes, single family build to rent portfolio later this year. And then we do it both with equity and with lending. So right now, we think some of the best risk-adjusted returns out there are in lending, and so that's an area that we're currently focused on. But we do all of those things. And did I mention self-storage? We are also actively looking at self-storage too.
Oh, got it. Okay.
Yeah.
For those investors that are either in, if you look at their investment horizon early in their career in terms of investing outside of the traditional markets, to like middle career to late career, or maybe not even career as much as like their time horizon in terms of their financial independence, how would you advise each of those different categories to invest in real estate?
Yes, and like you, I'm not a financial advisor, but what we talk about is, look, if you're younger, you got more time to take more risk, and you probably have some pretty, large aspirations that you haven't yet achieved. So I think generally speaking, younger people have a higher risk tolerance. The people as they get closer to retire have a little bit less of a risk tolerance, more focused on stability of cash flow to live on, and how do they build that? So When we talk with younger people, we're usually talking about equity plays. Equity plays into development tend to be higher return, higher risk than, let's say, an equity play, an investment into a stabilized multifamily, or a value add multifamily sits in between those, right? So helping people understand the risk with each type of investment, not just looking at the return number, and then lining up their risk tolerance with their return goals to find the right balance. So, on the aggressive side, that means investments more in development or maybe commercial, things that just have more inherent risk to it. Not all commercial, but certainly some commercial, vacant buildings, things like that. There's a great opportunity for a reward, but there is risk with it. So, the younger people tend to look at that type of the area of the portfolio more heavily. And then people who are either retired or close to retirement, they're like, okay, how do I count on X dollars a month? And so we look at the lending area. Lending is typically a much better place in the capital stack if things were to go boom and blow up. Your lenders get paid before any of your equity part investors, and so it's a place that's a lower risk, and typically lending will generate more steady income month to month. Whereas equity, a lot of times you'll have to wait until a payoff day at the end when it's sold or when it's fully developed and leased and what have you. So I would say that we look at that whole spectrum, and then we try to help people figure out where to customize their portfolio. And it's not typically just all one way or all the other. It's how do you blend it together.
Got it. Okay. And for those people that are in the audience, if you have a question, drop them into the Q&A, and we will answer them one-on-one. Lending. So I am interested in that. I'm familiar with lending like debt funds or income funds, but it sounds like your fund offers both equity, pref equity, and that's what I'm familiar with, but also debt and income type of instruments along with that. So for any one deal, how should an investor, and I think you went through some of this, but how should an investor think about either subscribing as an pref equity investor versus an income or debt investor?
Sure. So if we think about the capital stack in terms of how do you get to the whole capital that's required to do the project, whatever the project is, the debt comes first, wherever that comes from. It can come from a bank, it can come from a debt fund, it can come from our fund, right? But there's debt, and sometimes that's in layers. So sometimes there's a first position debt, and then maybe there's second position debt, sometimes called mezzanine debt, right? Sometimes there's even a third position debt. And then after the debt is your pref equity. So that means that gets paid out before any of the common equity or other classes of equity. So if you want to talk about like where the risk is, if it has to be liquidated, the risk as you go up to that common equity, that's where the highest risk is, because the debt gets paid first, then the pref equity, and then the common equity. So when you think about pref equity versus debt, they're very close to each other in the stack. And they could be in the same spot, because not every deal has both. Right. So what we've seen in one of our offerings is that there is a deal that has a bank financing up to a certain point. And let's say that's 65% loan to value, which is typical of a lot of development type of deals. But the developer needs to get more to 75 or 80% loan to value in order to really make the numbers work overall. And so sometimes that comes in as pref equity, and that's it. Or sometimes it comes in as a mezzanine debt layer. Right. And then pref equity may sit behind that. So it really depends on, do you have all those pieces in the cap stack for a particular project, or maybe you just have pref equity, or you just have a mezzanine debt piece.
Got it.
And a lot of times that primary lender, that first loan, will not allow mezzanine debt because mezzanine debt can enact foreclosure, right? It is on the deed, it is secured by the property. A pref equity position is an equity position. It can't foreclose on the property typically.
Yeah.
So
Yep.
more protection for the people in the mezz debt space, but generally speaking, about in the same spot on the capital stack.
Yeah. And then with not necessarily with pref equity, but with the common class of equity, usually with that, because there's higher risk, they do participate in the back end, like the
That's right.
profit split. So that's something to consider as well.
Yeah, and that's a great point, right? So pref equity and mezzanine debt might have a certain percentage return, and I'd say in our fund we look for 12+% to get to investors, whether in the mezz position or the pref equity position. Whereas at a common equity, people because of that position, you're looking for 14, 15 on a stabilized value add type of property, and 18 to 20 plus in a development or higher risk type of opportunity.
In this environment, and I hate to always ask this question, but do you have a preferred asset class? I know like asset classes and our opportunities are all like our children. You don't really favor one, but because of the kind of quasi high interest environment, historically it hasn't been that high, but quasi high, and knowing that the Fed is only going to lower interest rates probably once this year. Do you have anything that you prefer versus another type of asset class?
So we deal with the multifamily and self-storage asset classes, and
Mhm.
both of them are generally pretty high priced today, particularly when you factor in the interest rates. It's
Mhm.
hard to find a good deal that makes sense to put your equity into it. So I would say, do we prefer one over the other? No, it's really deal dependent, and they're really hard to find a deal right now that you can underwrite conservatively, that you feel confident that you're going to get the returns out of it. It's hard to find that. So I'll change your question around a little. This is why we like the lending space, because the people, the developers that are trying to and doing these types of deals, um, they need to get higher leverage than where banks are at right now. Banks are not willing to
Mhm.
be as free with their loan to value and as loose as they've been in the past. That's tightened up a lot. And in order to make those types of deals work, you need to lend. And we like that the risk adjusted return in lending on both multifamily and self-storage. Self-storage, which has typically been much harder to get loans against than multifamily, but both of them have the same situation, which is to make the deals work at today's prices, at today's interest rates, the developers or the sponsors tend to want to bring in loans or pref equity to make the numbers work.
Yeah.
And we like that space.
What do you think is going to happen in the next like half year to a year, given that Feds are going to lower interest rates? And I'm not talking about the general economy, but like maybe that with respect to real estate and the asset classes that you focus on, like what do you think the market's going to go? Multifamily is, getting the squeeze because people who locked in 5-year, fixed rates now are, needing to lock in longer rates, or, if they hopefully they've bought up or bought into lock rates at some point. They've locked the 5 years, but what happens after that, right? So you'll probably see a changing of these investments fairly quickly to minimize the risk. But looking at your crystal ball, like next 6 months, a year, what do you predict?
Yeah, I think you just shared a lot of what my perspective is that and it's not just, I mean, it's happening, right? The amount of commercial real estate that is coming with loans coming due that were deferred for the last couple of years. I forget the number off the top of my head, but it's staggeringly like twice as high as it's typically been.
Right.
And when we go to refinance, or when the owners go to refinance because their loans are finally like coming due, the value of the buildings is not where it was. Now, I think that's more so on commercial real estate than it is in multifamily. But I would
Mhm.
say a lot of multifamily projects that I see are running into similar situations where they bottom at such a high price point that it's not sustainable at these higher interest rates.
Mhm.
And so I see a lot of opportunity and hence more transactions going to happen here in the next 6 to 12 months. So that's why I still like the asset class. I think the time to get in is ahead of us. I think people who got into very tight deals in the last, 2, 3 years are going to find that a refinance out is not likely going to work without more capital in, which means the easy answer is sell. And they may
Mhm.
sell and do okay, but that will put more inventory on the market that I think we're going to see opportunities ahead of us to buy.
Yeah, I've heard of more and more of these funds that are focused on, um, the potential for these losses to happen. And then if these opportunities come to market, either they buy those opportunities, those investments, or they are in the lending business. They'll provide the mezzanine debt to provide the 1 or 2 year cushion that a potential syndicator or operator needs.
And that's the space we like right now is that, call it, some people have called it rescue funds,
Right.
provide a cushion to your
Yeah.
point to try to ride out the next couple of years, right?
Mhm.
We like that because, if you've got to, I mean, you have to do the due diligence, make sure that the asset's really worth both whatever debt sitting in front of you, but also, covering your debt that you're adding that mezzanine debt, but it's protected by all the equity that's been invested, right? By the
Mhm.
common equity. So we like that space in the short term, and we see then the opportunities coming to market where those aren't all going to work out, right? It's not there isn't rescue debt for every deal in every
Right.
situation,
Right.
and so they'll have to turn over. And in some cases, it may be, hey, the project wasn't a home run, but we made some return on it, and in order to refinance it, we're going to need to put more money in. Maybe we just take our small return, move it on to the next person, right?
Mhm.
And so that also, it's going to put inventory on the market. And the more inventory on the market, the more opportunity there is to find a deal that works at the right
Um,
risk point.
as an investor, how does someone vet and or underwrite a deal? Like, let's assume that the investor is either just starting or maybe they have some knowledge about underwriting. How do they, or what are some key metrics that they should be looking at when they evaluate either a syndicator or a fund that invests in like rescue operations?
Yeah, so I mean, I would say a couple of things. One is when we look at a deal, whether it's for debt or equity, so I'll broaden your question a little bit.
Hmm.
We look at various pieces. We look at what is the market, what is the sub market, what is the financing situation, and the business plan and the sponsors.
Hmm.
So we look at all five of those, and if you don't mind, it's free for your audience on navwf.com. We have a little 5-part video series that explains it. It's our syndication system, and so we would look at all five of those when we do due diligence on a deal. And then the one around the business plan is the underwriting that you just asked specifically about. And so when we're looking at it from a debt perspective, one of the biggest thing is for us is the loan to value ratio. So when we add up
Hmm.
all of the debt, that's the debt that we're providing through our fund, as well as any debt that sits in front of us in the capital stack that gets paid before us. Add that together versus where we believe the value of the building is today and where it will, if it's a development, where it will be after the capital is deployed. That loan to value ratio, the lower the better, because that means it's more protected.
Hmm.
And typically if it's under 65%, a bank will do it, right? So it's more like we want to be under 75, maybe 80, is where we think that there's a good place to be. Assuming all the other pieces fit together. We like the market, the sub-market, the business plan, the sponsors, right? If all that fits in, a 75 to 80% loan to value ratio, for us, that makes a good place to lend. And of course, an interest rate that is attractive to an investor to sit in that position. So that's what we look at for lending. When we look at it for equity, there's a few things that go into underwriting that can drastically change the value and the outcome of the building, as I know you know. So, the cap rate, the cap rate and the rent raises, right? If the rents are too aggressive and they don't match up with where the market is or where the market's going, it's very easy to make any deal look good.
Yep.
A cap rate, which is a factor that's used to determine the value of the building based on how much income it makes. If that factor changes by half a point, which seems like almost nothing, it can change the value of the building by millions. And so, expense ratios, I mean, you'll see expense ratios sometimes on very aggressive underwriting at 30%. Oh, it's a new building. It's almost got, no expenses. I mean, it's unrealistic to be sustainable. And so we look at those different factors when we're underwriting a deal. And, people who look at that and get super aggressive, they're the ones maybe that were able to buy a deal the last couple of years that we're probably going to turn over again in the next year or two. And there's our opportunity. So we like to look at things conservatively. We don't want to, hope that interest rates stayed where they were at 3.5% a few years ago. Like that didn't seem like a sustainable thing. So look at it conservatively, look at those key input metrics and make a good judgment.
For those people that made an investment with an operator in the last year, 2 years, 3 years, and they've been kind of sitting back and either getting the pref equity, right, or other type of returns, what should they be cognizant of when they're looking at the health of a particular investment? Is there obviously there are clear signs like there's a capital call? Well, that's a red flag. Not necessarily horrible, but that's definitely a red flag. The seizing of actual equity returns, right? That's another red flag. So, what are some red flags that you've seen in market that investors should be cognizant of?
Yeah, I mean, I think the early indicator is if your sponsor is not communicating with you or answering your phone calls, there's a problem. Right. Now, the unfortunate part, a lot of times as a limited partner and investor, there's not a lot you can do, but you certainly are owed information. Mm-hmm. At least that's the way I look at it, is we like to be transparent. And so I would say, you asked what are the red flags? Certainly, if you're not getting information, there's something wrong. Right. If the information you're getting is things like, hey, we need to, refinance unexpectedly and we need more money, or we need to take on more debt that we weren't planning as mezzanine, or we have a new pref equity offering for you to double down your investment.
Right.
All the types of things that we just talked about, that says it's not going well. Now, that doesn't mean that it can't have a good outcome on the other end. Mm-hmm. And so, if you really want to get into it, you need to get the information and try to understand where your risk point is today. Unfortunately, in many cases, there's not too much you can do about it unless you're in this business and you can actually jump in and help your sponsor do something different. And some people are. And I've seen that where some LPs have stepped in and offered a lot of help and expertise to try and, I would say save or improve the outcome that would otherwise happen. So a lot of times, as you know, John, the investors that are in these deals are people who, do it themselves and then invest in other people's deals also. So there's a lot of expertise sometimes to tap in your limited partners. And I think that's always good to do that where you have them with expertise.
Are there risk mitigation steps or activities that investors could take? For example, obviously, like vetting the operator, that's understandable. But maybe like just making one investment in an operator, seeing how that goes over time, and then operators typically have some very, very active operators will have deals that come out like every month, but some will have deals that come out like every quarter or every maybe one or twice a year. And so one step might be just invest once, see how the operator does, and then potentially invest another time if the operator is performing. But are there other steps like that where they can hedge their bets? They can take some. Maybe it's like investing in other asset classes if they want to hedge that bet.
Yeah, I think there's different ways you can hedge it. So, I mean, like you said, you could diversify across asset classes, you could diversify across geographies,
Hmm.
right? I mean, what's happening in Boston, I'm in Boston, Massachusetts, is probably different than what's happening in Portland, which is probably significantly different than what's happening in Phoenix.
Right.
So, I mean, there's a lot of ways to think about diversifying from, geography, from operator, asset class, lending versus equity. Um, and so I think all of those are on the table. One of the things that I, I guess I would encourage people to do is to make sure they're going deep with an operator, right?
Hmm.
And so you want to get to know somebody well enough that you're willing to not only give them your first investment, but give them future investments. I'm not
Right.
suggesting you give it all at once without knowing, but if you really want to invest in a relationship where you understand how that operator thinks, how they look at deals, how they look at risk, and that's aligned with what you want to do, then that takes more investment than just writing a check. And,
Right.
so I would just say, I would caution anyone from saying, I know 12 people, I'm going to give them all a certain amount of money and see what happens.
Right.
I think you're probably not dialed in enough in your due diligence to pick the right approach for what matches your goals.
Hmm.
That doesn't have to be one, but 12 would be too many, I think.
Yeah. And I, again, encourage people, if they have questions, to submit their questions to the Q&A box. Um, a couple of questions that we do, we're not wrapped up yet, but one of the questions that we do use in our wrap up is, have you come across, or not, maybe not in any of your investments, but other investments, come across any deals that went south, like things that went horribly wrong or not according to plan, and then possibly as a corollary to that, like how do you protect yourself against that, or how do you correct those issues?
Yeah, I mean, so I mean, I know of a. You could probably point to every deal that needs rescue funding right now and
Right,
and
right.
determine some of what went wrong. But I would say that we talk about development being higher risk. Well, why is that? And I mean, I can talk to one deal that um, development went off the rails in terms of cost.
Hmm.
And it went off the rails. It seemed like it was a good, solid plan to start, but what was not in place was permits, and it was a redevelopment of a building. There was adaptive
Right.
reuse, and it sounds conceptually simple, right? Okay, I already got a building. It's all it's mostly there. We just need to make some adjustments to it. But if you don't have permits, you have I don't want to say no idea, but you probably don't know what it's going to take to actually do the work.
Right.
And in this case, it was a change of use. And in that change of use, the city required that the new use meet the new code. And so that meant that anything that was existing and functioning, but did not meet the newest code, needed to be redone.
Hmm.
And so that can drastically change. If you're not planning to rewire the building and you need to rewire the building, like that's a lot of money. So those types of things. So one was just you don't know what the plan is until you're actually permitted with drawings. So
Right.
you got to understand that risk. And then this, and by the way, if it's permitted with drawings, it's probably too late to invest in it. So you just got to understand how close you think that estimate is, and is there enough contingency in there?
Yep.
And then the second thing is don't underestimate the amount of time it takes to get that permit. It
Right.
is amazing how not, I mean, we could talk about the wheels of government turn slowly. Well, getting approvals from boards and all the different departments, and then all of a sudden other neighbors weigh in and like all it can drag out from what seems like should be 3, 4, 5 months to like a year.
Mm-hmm.
And as you know, in this environment, the carrying costs at the interest rates, particularly when you're talking about development deals which have higher interest rates, that is a very expensive thing. So looking at what if it took twice as long as expected, what would happen? Like that would be a way I would look at it and say, what if it would cost twice as much? What if it took twice as long? What would the outcome be?
Yeah.
Now it's probably not good, but how bad is it?
Yeah. Yeah.
And that might be a way to help protect you from getting into a deal you're not comfortable with.
Yeah. And that's not to mention, if you are developing, unless you're fully integrated, you have to work with your builders, right? And they are on a timeline. So if you're delayed in your permit process, that delays them, and they might just go on to the next, opportunity, right?
Yeah. Hey, we got the permit. Great. I'll see you in 4 months.
Right.
What?
And there's kind
Yeah.
of scary. Um, how do you like to give back, you and your organization?
Yeah, so we give back through a lot of informal mentorship. Both Jeremy and I, we both run meetup investment clubs in our areas. He's in Green Bay. I'm over here in Boston. And a lot of people charge for mentorship. We don't do any of that. We help people, like I said, meet them where they're at. And if they want to invest with us, that's great. But many times people say, I'm just comfortable investing what I know in my local area, and we help them underwrite, a two-family deal down the street or in Western Massachusetts, or and people say, hey, that's what I want to do. I'm glad to help you. I'm glad to provide my time and expertise because I was there, right? I was there, 10 years ago, and you don't know where to go. There's not like there's a easy classes and things. There's ways you can teach yourself, but it goes a long way to have somebody who's been there to say, here's how I'd look at it, and this works or it doesn't, and here's how I think about it. And so
Yeah,
that's what we do.
that's great. Again, I encourage everyone to ask their questions. Is there anything that we haven't covered that you think investors, either whether they're starting out or they're middle in their investment career or maybe later in their career, what they should be considering when they think about, again, real estate in their portfolio? Again, the 70% of the investor market has not even considered real estate apart from their private residence. So what should they be considering, throughout their lifetime?
Yeah, so I mean, I guess a few things that we just haven't touched on yet that I found to be important is understanding what all your available sources of investing capital are.
Hmm.
And it's not just the money you have in your bank, but a lot of times it can be retirement funds. And I know your audience has probably heard others talk about self-directing retirement funds. And so that is an area that I think many people just don't fathom that they could touch that,
Mhm.
and that they could touch it in a way that maybe it's not everything, right? Maybe they just say, hey, this is new to me. I don't think I want to take my entire life savings, which is largely in an IRA or an old 401k or whatever. I don't want
Mhm.
to do, but but maybe I could take 50k or 100k and I could go do something with that. So I think retirement funds are generally thought as or generally an untapped area people don't think about and or don't know that they can do something with.
Yep.
Another is, maybe in your area, my area for sure, home equity is, we've had home price. I think the average price, I might shock some people and others will say that's fine. Like in Massachusetts, the average single family home hit over $600,000
Wow.
this
Yeah.
year. I think 630 was the last number I saw. And a lot of people bought those houses at 200.
Right.
So there's a lot of equity in housing. I've personally done it. I've taken HELOCs or
Yep.
refinanced my house back when the interest rates were lower. Too late for that now, but
Yep.
there's opportunities to pull equity. And I'm not saying that's always the right answer, but it is just another pot. So think about all your sources of equity and how is it working for you? If you don't have all your equity working for you in a way you want it to be working for you, then it's time to do something about it. So I would suggest that people take inventory of that.
Yep. I also have taken a HELOC. In fact, I have a HELOC right now where I'm doing the arbitrage of HELOC I think my HELOC caps out at like 8%, which I got my HELOC way back when, and I'm investing in something that is paying like 20 to 24%. So it makes absolute sense if you make sure that the investment is fairly risk-free. Otherwise, you could be in a world of potential hurt. So just make sure you do your due diligence.
Yeah, yeah, and just a kind of similar story, right? 20 apartments in Western Mass I bought 4 years ago personally. I wasn't a raise, it's just something I bought. Did it all on my HELOC. My HELOC that again, at the time it was 3%. Now it's at 8. But that investment in 4 years has doubled, and it's cash flowing every month, and it's paying even at the 8%. The HELOC back at 8%.
Yeah.
I actually had my property manager call me yesterday and say, I can get you more than double for your units what you paid. Do you want to sell them? And I said, no.
Right.
They're making money every month. I'm good.
Yeah.
And they're doubled in value. Perfect.
Right. We do have a question that came in. Any concerns in the multifamily space with Joe Biden's proposal of nationally capping rent increases to 5% or $55?
Absolutely. Yes. Rent control. Rent control. I mean, it's not just a Joe Biden thing. I guess, look, I would be surprised if a national rent control could actually get through Congress. And so I don't think the national level rent control is a realistic possibility in the near future. I think there's too many areas of the country that would revolt against that, and just wouldn't get through. With that said, it's absolutely a concern in areas that it's either in or being considered. So Boston's one of them. Boston rent control is a real concern, and there's a reason I don't invest in Boston. That's one of them. New York City rent control, like it's a real concern, and so you got to know what you're getting into with that. When you don't have the free market to do what you need to do to keep your business, and owning a property is a business, you can't do what you need to do to keep it profitable. It really hamstrings you. What else can you do? You can't change the taxes. They're going to be what they're going to be. The insurance company is going to charge what they're going to charge.
Right.
Like, your only leverage, you can shave some expenses here and there, but your only leverage is going to be changing the rent. If you can't control that, and I'm not a big proponent of jacking rents up beyond what needs to be, what the market is and so forth. Like, I don't think that's a good idea. But you really lose your ability to run your business. Rent control. So I'd be worried about it. Not nationally, but in the pockets where it's happening.
Yep. The one other thing that I was thinking of when you talked about the investing out of your retirement accounts, oftentimes that's either post-tax or at least tax deferred is taxes. So as a lot of people in our audience are in the tech industry, or tech or other professions that have like high disposable income that can invest in investments like real estate. How do they or can they think about reducing their taxes or kind of tax mitigation? Like, we all want to pay Uncle Sam our share of our taxes. How do we mitigate our taxes? And I should know some of that because you mentioned you work for Accenture. I worked for Arthur Andersen way back when. And so in their audit division, so not necessarily taxation, but yeah, how have you helped your investors?
Dare the eccentric consultant tell the Arthur Andersen auditor about saving taxes, but
right.
So I guess I'll just add a couple of things, and you're probably much more the expert given your background. With that said, two things come to mind. One is when you're investing in your 401k or your 401ks and IRAs, right? If you're doing self-directed, 401ks do not have UBIT, is my understanding. That's the unrelated business income tax, which basically means your retirement account gets taxed on certain portions of the gains. The IRAs do. And that's actually one of the things that IRA holders really like about lending. If they lend, then you don't have UBIT because you are the direct lender. You are not an equity investor that gets leverage from debt. And so for anyone who's like, I don't want my IRA to have to file tax returns, and I don't want to have to pay taxes, and it confuses a lot of people, and it doesn't always work out, financially when you stick the taxes in there. Lending is a good place to deal with that or not have to deal with that in your IRAs.
Okay.
So that's on that side. And then obviously, if you're just a straight equity investor, there's a lot of this depreciation that you can get. There's normal depreciation. We got bonus depreciation that's still available. There's a cost segregation studies that allow you to depreciate more quickly. So many equity investors will see significant losses on their K1 the first year. That can be deferred against other similar kinds of gains. Every W-2 employee wants to reduce their W-2 income by using real estate. I don't believe you'd have to talk to a tax professional to see if that's possible. I haven't found a great way to do it.
That's right. Unless you're
you are a real estate professional.
That's right, exactly right. That's what I was going to say. Unless you're rep, then it's often difficult. The one thing I'm considering is oil and gas, where they have the tax really it's tax deferment, but it's also tax mitigation in the first year or two. There's the risks with that. So I'm not suggesting oil and gas at all as an investment, but there are definitely tax advantages as well.
Yeah, I would love to learn more about oil and gas for all the reasons you just said. I'd love to have that as an offering in my fund. But I invest in what I know. I don't know oil and gas. I live in Boston, not Texas. Gas, as far as I'm concerned, comes out of a pump at a gas station, not out of the ground on an oil well. So, I got to invest in what I know, and I would love to partner with somebody someday that really knows that area well to create an offering for my investors.
Yeah, well, let's talk offline about that. We don't have one just yet, but we do know some experts. We can definitely point you in the right direction.
Great.
We are about time. If no one else has any other questions, we're going to wrap it up. Thank you very much for your great presentation, Michael. A lot of great learnings today. And if you want to learn more about how to use real estate, leverage the real estate to retire confidently, feel free to contact Michael. Michael, is your either your website or your email address the best one? Do you want to share that?
Yeah, sure. Email address is michael@navwf.com. NAVWF is Navigator Wealth Fund. Or you can go to navwf.com and schedule a call. Glad to chat with anybody who's interested.
Okay. And we'll include your information in the description for the webinar and the podcast as well. Thanks for educating us on retirement with real estate. We learned a ton, like I said earlier. And thank you for taking your time out of your day to share your wisdom with us. Don't forget to like and subscribe to our podcast, whichever platform that you're listening to or watching this on. And make sure you, of course, ring that bell so that we can continue bringing you the best educational content ever. Thanks, everyone. Until next time, keep investing for generational wealth. Thanks.